hypothesis, and in this presentation we will cover the various types of tests used in the weak market. In order to verify the weak form of efficient market hypothesis, there are three types of tests. First, serial correlation test, second, run test, and third, filter rule test. In year 1964, Murray took up a test called serial correlation test, in which he found the serial correlation of weekly security prices. Later on in year 1965, Fama also tested the same test on daily price changes, and he studied the correlation for 30 firms which composed of Dow Jones Industrial Average for past 5 years before 1962. Serial correlation is said to measure the association of series of numbers which are separated by some constant time period. Under this method, the price change in one period, let us say 1 week, is correlated with the price change in other period, that is next week. And if the value of correlation is near to 0 or equals to 0, then it is said that change in price is serially correlated. Second test to verify the weak form of efficiency is run test, and this test is also made by Fama to find out if the price changes were likely to be followed by further price changes of the same sign. This test ignored the absolute value and took into consideration only the signs. The signs may be in positive or negative. When there is increase in the price of share in the following day, then it can be denoted with positive sign. And if there is decrease in price of shares in next day, then negative sign should be placed. The run tests are made by counting the number of consecutive signs or runs in the same direction. And this concept can be explained better in the example given in next slide. In this example, we have taken the price of a share for 10 days. So from day 1 to day 10, so you see in the slide that day 1 the price is 250. So we will take it as a base price. And on day 2 it is 290. As you see that there is increase of 40 rupees. So we will put plus sign in front of day 2. And on day 3 there is fall in price from 290 to 267. So we will put minus sign in front of day 3. Then on day 4 we have again a fall of 17 rupees from day 3. Because in day 3 we have a price of 267 and on day 4 we have a price of 250. So because there is fall in price, so we will put minus sign. So this process can be done till day 10. Whenever there is increase in price from the previous day, we will put plus sign, and whenever there is decrease in price from the previous day, then we will put minus sign. And on the basis of this, we will calculate the total number of positive sign and negative sign. As you see on day 2, 5, 6, 7 and 10 we have plus sign. So total number of positive signs are 5. And on day 3, 4 and 8, 9 we have minus sign. So total number of negative signs are 4. So after getting the total number of positive and negative signs, the next step is to count the number of consecutive signs in the same direction. And the number of consecutive signs are known as runs. Here you see that there is plus sign in front of day 2 and minus sign in front of day 3. But what we have to do, we have to count the number of consecutive signs. Means here we have only one plus sign which is followed by a minus sign. So we will not consider the minus sign, we will take only plus sign. So which is number 1, that is the first run. Then on day 3 we have a minus sign. Next on day 4 again we have a minus sign. So we will take these 2 days as run 2 because they both are having same sign. Then on day 5, 6 and 7 we have plus sign. So we will take these 3 days as third run. Then on day 8 and day 9 we have minus signs. This is the fourth run. And on day 10 we have plus sign. So this is the fifth run. So total number of runs are 5 in number. So we can say that a run occurs when there is same sign for 1, 2 or more than 2 days. And whenever there is change in sign, the run ends and new run begins. So these are the actual number of runs that are observed. And now they are compared with the number of runs that are expected from the price changes, and on the basis of which the results were generated. If there was not a significant relationship between the returns of securities of one period and returns in the prior period, then it was concluded that the security prices followed a random run. Third test to verify the weak market is filter rule test. Filter tests are made because the technical analyst believed that the serial correlation tests were not of good measure. Because if there was no statistical significance in serial correlation, there could be no economic significance in price changes. This test was made by Alexander in year 1961 to find out that if any abnormal return could be earned using the past price data, and then it was used by Fama and Bloom in year 1970. The filter rule is generally based on price momentum or the belief that rising prices tend to continue to rise and falling prices tend to continue to fall. A certain percentage rise triggers a buy, and while a certain percentage fall will lead to sell. So traders try to avail the opportunities by looking at the trend and trading accordingly. Like if stock price moves up by say X%, then trader will buy it or hold it. And if it reverses by the same percentage, then it's up to him whether to take a sale decision or not and take a short position in it. This is all about the tests which are used to verify the weak form of efficient market hypothesis. Thank you very much.